Well, the disappointing jobs report on Friday cemented the case for a September Fed rate cut, seeing treasuries rally across the curve and the dollar face headwinds, even as stocks largely took that data in their stride. Meanwhile, political developments remain in focus as the UK cabinet is reshuffled, the Japanese prime minister quits, and France looks set to descend into shambles as well. Looking ahead, US CPI and benchmark payroll revisions arrived this week, while the ECB are set to stand pat on Thursday with the easing cycle pretty much done and dusted in the Eurozone. Plenty for us to discuss on the trade-off this week. Without further ado, let's crack on with the show. So it was a busy week for the markets last week. Looks set to be another busy one this week. Joining me as always to try and make sense of everything that's going on is my very good friend Ryan Littlestone from Forex Relied and Forex Analytics. And let me just assure you, on the day news broke of Treasury Secretary Scott Bessent offering out Federal Housing Director Bill Pulte after a dinner last week, there'll be no fighting on the trade-off this week. All is well in good ship Pepperstone. Good afternoon to you, Ryan.
Good afternoon. You're staving off what we were talking about earlier. We nearly got in a punch-ups over your shirt.
Well, so given that you're about a foot taller than me, there are going to be no punch-ups going on whatsoever. I'm a wiser man than to take you on.
Well, I can go on my knees if you want. But I see you got the old Jeremy Clarkson number on again, so we must be entering autumn and farming season.
There's nothing wrong with my shirt. It's not a tablecloth. It's not a dishcloth. It's not a tea towel. You can't play Connect 4 on it. It's not a shirt either.
It's not a shirt either. But anyway, let's move on.
Oh, dear. Right. Enough fashion advice. Let's get on to the jobs report. Right, headline non-farm payrolls, pretty downbeat in the August jobs report on Friday. Payrolls rising by just 22,000 last month, with the net revisions also pretty grim as well, down 21,000 on the net figure, which means that the US economy lost jobs in June as a result of that revision, and that's the first fall in payroll employment since the back end of 2020. That net revision also means that the 3-month moving average of job gains now stands at just 29,000, which by most estimates, is about half the break-even rate, which is not great, to put it politely. When you dig under the surface of that payrolls number, why is the US economy adding jobs? Well, in short, the economy is only really adding jobs because the population is getting older. If you took out the jobs that are being added in healthcare, employment in the US would pretty much have been flat since April, which is clearly a rather downbeat situation. And that, of course, comes ahead of the benchmark revisions that we get a little bit later on this week, on Tuesday, in fact, which are likely to lop around 800,000 off payrolls in the 12 months to March of this year. So clearly, the labour market has gone from stalling to arguably cracking per the jobs data that we had out on Friday. The household survey was also pretty downbeat, with unemployment rising to 4.3%, a new cycle high, while underemployment that rose to 8.1%, also a new cycle high. And I guess the only sort of brightish spot in that jobs report would be the rise in labour force participation, which ticked higher to 62.3%. Although you've got to remember that that is coming off a very, very low base due to the immigration enforcement that we've been seeing. So it's probably not worth celebrating too much. On the whole, though, I would say this doesn't change a lot for the September FOMC meeting. I think we'll still get a 25 basis point cut from the Fed next Wednesday, although there is the potential that we see more dissenters now in favour of a 50 basis point rate cut. Steve Moran will be one if he's confirmed in time. Maybe Chris Waller, Mickey Bowman may join him in that camp. But I think this does increase the risk of the Fed moving in terms of consecutive rate cuts as opposed to the gradual pace that we've been expecting. But the key question I have is, what does this labour market report actually tell us when you take a bit of a step back? Is this recessionary? Is this structural issues under the surface of the labour market? Or is this an adjustment to the one-off shock of all of the tariffs and all the nonsense around Liberation Day at the start of April that is just sort of slowly but surely making its way through the labour market? My gut feeling, and I think you do need a bit of a feeling around this as opposed to looking at the numbers in their isolation, is that nothing really feels recessionary right now. And I don't think we can entirely rule out the Fed are about to embark, or resume, I should say, their easing cycle as we pretty much move through what August or September could be a trough in this labour market weakness. And of course, that potentially poses further upside risks on the inflation front as well. So a downbeat jobs report towards the back end of last week. It does tilt Fed policy risks in a more dovish direction as we move through the back end of the year. But I think all of these people screaming that the end is nigh as a result of one or two payrolls numbers are probably going to be wide of the mark.
Yeah, I think there's a big risk of that. The market getting too bearish on the US economy, on the jobs market on the back of this. Next month we probably going to see the government jobs coming through, so we could get a real big negative number, which we'll have to make sure whether it's in the government or not. Yeah, it's below break even. It's been revised down. It's looking weak. We know there's a lot of factors behind it, particularly that immigration story. We heard about this South Korean battery factory rounding up 425 odd people and shipping them out, production stopping and whatever they were building. So I think there's two sides to this. Something's got to fill the void. So if you are taking out that many jobs, low paid jobs or immigrant labour from the market, it's got to be replaced, because firms aren't just going to go, well, we've lost 200 people, we can carry on without them. So who's going to step in? Either properly certified, shall we say, immigration labour that qualify with the right paperwork, or we're going to get US citizens stepping in and doing that. But if that happens, I think you're going to see wages rising, because those sorts of people aren't going to be accepting the pay deals that these immigrant labour force is taking. So that's going to be an inflationary pressure. But overall, I see the labour market, I say, aside from some sort of blips like on the government jobs, I can't see the labour market collapsing. Yes, we may stay low. Yes, we may see a couple of small negative prints, but it's probably going to soft land. And then as long as the economy as a whole doesn't roll over, it's probably going to start growing again, and we'll see those spaces filled. But just before that, talking about the Fed impact, and this is what we were saying last week, this week is going to be big, and this data for the Fed is going to be big. And I was speaking about 10-year yields last week, and here we had the break under this 420 level, heading down towards the 4% mark, and this is a proper move by the looks of things. And if it's maintained, the risk for the Fed is that not what they do at the September meeting. We know it's going to be a 25. I think 50 is off the table. But those forecasts are going to be super important. How dovish are they going to get over this data?
Yes, I think that's certainly something to keep an eye on. We get new dots next week as well, which the market will, of course, go dotty over, to use the pun. You've got those cards handy. So I think 4%, a move below 4% on the 10-year might be a little bit tough without an overtly dovish Fed next week. But it's going to be interesting to see how this shakes out. I mean, I would still be categorizing things more as, when we look at non-farm payrolls data around a hurricane or wildfires or something like that, where you have a few months that are distorted by a one-off freak event. I mean, they're natural events. This one was man-made by the bloke in the White House, but still, I'm with you. I don't see any real signs that things are going to start crashing and burning. Obviously, we may be wrong. That risk is there, particularly if uncertainty continues to paralyze businesses for a prolonged period of time. But I think by and large, we are close to, if not already at, the bottom in terms of the US job story. Go on.
Can I just ask a question? That 4.3 unemployment rate, I know you like to count it down to 30 decimal places. Was it a proper 4.3, or was it, marginally up from the near 4.3 it was last month?
Yeah, you're going to have to come back to me because I don't have the data in front of me, but I can very quickly work it out. If you talk about CPI, I will do the maths while you're doing that.
It's all right. It's not that important, but I will talk about CPI anyway. And as I said, last week, I said, trading's going to be back with a bang this week or last week. And here we are right in the thick of it. Now, while we've had the NFP report, all the doves are chirping loudest again. The hawks might get their squawks heard if this week's inflation data comes in hot again. In a change to the usual, we actually get PPI before CPI. So that might create an additional bit of spice and volatility due to PPI tending to be a bit more volatile in variations from what's expected. Year-on-year PPI is expected unchanged at 3.3%, and the core's dropping 2 pips to 3.5%. Now, on the CPI number, expectation is for the headline to rise year-on-year to 2.9 from 2.7, and the core set to be unchanged at 3.1. Now, given how Powell remarked at Jackson Hole that the labour market is really the main focus for the Fed now, any dollar rally on hot data, particularly in these inflation numbers, may not last given the market's reaction to the NFP. Now, as Michael's just mentioned, with future rate expectations past September, and I mentioned last week about, how forward-looking the market is, this data, again, is really about how dovish the Fed may get over the next 6 months. And all of the NFP and inflation data will be the final decider for those Fed rate expectations, i.e. the dot plot, which, as we just said, is due to be updated at the meeting as well. Now, be mindful that the market is always inherently more dovish than it ever is hawkish. So any dollar rallies on things like hot CPI data or inflation data is most likely to get hit, which for me is maybe a bit of an opportunity I'll be looking to trade as the week progresses. Now, if both CPI and PPI come down in any way, it's going to be the Dubs who are partying atop the tree come Friday's close, I think.
Good stuff. To answer your last question, 4.3237% was the unrounded figure. So sort of middly number. Anyway, moving on to inflation, Battle of the Birds. I thought you were going to talk about a Saturday night in Bournemouth, but we're talking about CPI and PPI instead. So we should probably cover that. I think you're absolutely right. I think if we do see the numbers come in a little bit soft, the market is obviously then going to take that as a green light to run away with the idea, not only in terms of pricing a 50 basis point cut, but also probably pricing 3 cuts by the end of this year at least, and also pricing a lower terminal rate at some point in 2026. There's a few reasons why we probably shouldn't do that. I think one is you've got to remember that PPI certainly excludes tariffs by and large, so that's one thing to consider. The CPI numbers, yes, the tariff effect is starting to show up and focus on that core goods number for the precise impact there. But you've got to remember that the impact is not just going to arrive in 1 month, because we all knew the tariffs were coming. So businesses are sort of still working through the stockpiles that they built up from all of that front running in the first quarter. They're slowly but surely passing those prices on along the value chain. So I think, we're probably not going to learn especially much from the CPI data this week. I think if it's a hot number, the Fed will largely look through that. Powell, as you alluded to at Jackson Hole, talking about a one-time shift in the price level and unlikely to be posing risks of persistent inflation. If we get a soft number, well, we know those upside inflation risks are there, so it's still not really going to push the Fed into a larger cut at that meeting a little bit later on this month. But as you rightly say, that's not going to stop the market from running away with itself regardless.
Yeah, exactly. And I know many people make the argument that you've made about tariffs don't appear in PPI. They sort of do. They don't appear in terms of, someone's paid a 15% tariff buying goods from China that they then produce and sell on. But if they are paying that tariff, it's down to them whether they're going to pass that on to their finished goods, which is what PPI does count. So it's a known unknown, should we say, how much gets passed on. So in there somewhere is the tariff effect from that. So it can't be ignored, but we just don't know what it is in effect.
Yeah, no, you're absolutely right. Do you want another known unknown in terms of tariffs?
Go on in.
Portfolio management fees, how much are they going to skew the index?
Don't start with that again. Oh, if we have that, well, they should fall out of bed this month, really, because everyone was on holiday last week.
For those who are unaware of why we're giggling about that, the portfolio management number did skew PPI higher in the month of July, but someone somewhere doesn't believe that that's actually the case. So
never heard of it. Never heard of it in all my years. Never heard of it. I've never heard of it in all my years. Portfolio management fees.
There we go. Uncle Albert, Victor Meldrew rolled into one down on the south coast.
That's why we've got you, because you dig through all the useless points like that to make our lives better.
Yeah, I like to think of it as adding value, but whatever floats your boat. Right. Moving on, the ECB, the Fed, of course, set to resume their journey back towards neutral at the September meeting, and obviously beyond that, the ECB, well, they're already at neutral. So I think it's time for President Lagarde and her colleagues to put their feet up for a bit, to be completely honest with you, and hopefully stay quiet, because that would really do us all a favour. The deposit rate is pretty much certain to be held steady at 2% this Thursday. All of the other key rates that the ECB set also likely to remain unchanged, with the Governing Council set to reiterate their data-dependent and meeting-by-meeting approach to future policy decisions, while also again confirming that they're not making any pre-commitment to a particular rate path, very much in line with the guidance that we've heard for much of this cycle now. Having said that, I think they're done. I think the ECB are pretty much over in terms of rate cuts. Downside risks to the growth side of things are diminishing pretty quickly. The euro is relatively stable, and I'm sure Ryan's going to show us a chart of that in a moment. And inflation is pretty much at target, and we expect a modest undershoot of that target next year. So everything points to their work kind of being done for the time being, as long as that baseline holds. And I think the latest round of staff macroeconomic projections are likely to strengthen that idea. Nothing with the economy has really changed since the last forecast round in June. The big one is that they obviously struck a trade deal with the United States, but from memory, the potential downside of no deal was not accounted for in those projections. So there's not likely to be any benefit from that deal being struck in the forecasts. The GDP projection should probably remain unchanged then at about 1% this year and next year. And you'll probably see the inflation path remain pretty much unchanged as well, that undershoot in 2026 that I alluded to, before we get back to around the 2% target in 2027. So if the baseline holds, the ECB are probably done. Would they cut again? Well, if trade tensions flare up, then yes, potentially. If the euro strengthens significantly and in rapid fashion, then again, yes, they may look to deliver another cut. Of course, Vice President de Guindos has put that sort of line in the sand around the 120 figure, saying that a move above there could be complicated. But my base case is that the ECB are now on hold until the end of next year. But the market prices about 20 basis points of cuts over the next 12 months, which feels a bit over the top to me. And of course, you've got to combine that with the Fed likely turning in a more dovish direction. So I'm going to have to go and wash my mouth out with soap after I say this, but is there a bit of scope for some euro upside?
Ooh, well, that sounds like a bit of a bet on the card.
Oh, here we go. Christmas is coming. Someone wants their lunch paid for, don't they?
Well, I'm going to see if I can make it 4 out of 4 if you want. I'm not in disagreement with you over the euro. I am in disagreement over whether the ECB cut again, because I've been saying it all year that I thought that the ECB are going to have to take rates lower than they'd like. And the way the economy is performing at the moment, I don't see any reason why that's not going to happen. The anemic growth they've got over there, if it continues, is going to lead to even steeper, price cutting by firms, and that's going to take inflation down and force the ECB's hand in maybe taking rates to a more expansionary setting, shall we say? You have to look at the Centex report that popped up this morning, a bit of a negative, not a huge report that I pay much attention to, but
has anyone ever paid attention to that since it started coming?
Well, I did today because of the comments they made, and I'll read you the first line. They said the new September data from the Centex dashes hopes of an economic recovery, and it's pretty much shined a light on what we've seen already. Everyone's waiting for this super spending to come in, particularly in Germany. It's not happening yet. Yes, it might be a long drawn out process, but something's got to start happening soon, as I say, or governments and the ECB are going to have to start thinking about, whether they do need to start easing again to get the economy rolling. But turning to the euro, I agree that there is potential upside here, and particularly this week. I think, whether we get hot CPI, I think this could be, heading much higher. If we get softer CPI, I think this could be heading much higher. And, if that's the case, we could be at 119 in a blink, maybe even end up at 120 and putting Mr. de Guindos and his level to the test. So, yeah, on one side, I can see scope for the euro going higher on this. On the other side, I think I'm I'm happy to make a bet with you over whether they cut again or not by the end of the year.
Right, well, that's another trade-off bet on then. ECB on hold versus ECB to cut by year end, and we'll have a lunch and a beverage or four at Christmas on that one. That's Europe done. That's the US done. What about Japan? They seem to be quickly sliding into shambles as well.
Yeah, and politics ruling the roost over there as well. I do feel a bit sorry for the Bank of Japan sometimes. They always seem to take one step forward and two steps back, or two forward and one back, and that's exactly what's happened again. Economic Minister and Chief Tariff Negotiator Akazawa finally got Trump to rubber stamp the trade agreements last week, something that has been causing much anxiety in Japan, as they're a stickler for crossing the I's and dotting the T's over there. Then the Bank of Japan got some good news because they saw real wages turning positive for the first time in 7 months. So that's their two steps forward towards another hike. But now they've been knocked back a step after PM Ishiba finally threw in the towel and resigned. Now there's some talk that he might have tried to hold on a bit longer and stop a leadership vote yesterday by dissolving the Parliament and the Diet, and thus forcing a general election. But it seems something has changed now, and he's jumped ship anyway. There's going to be a leadership vote now, likely early October. I think the 4th has been touted. But now the BOJ have more political uncertainty to deal with. They've been edging, I think, towards another hike as the data has held up fairly well, particularly inflation. So even amid any political strife, they may still pull a rabbit out the hat between now and the end of the year. But politics aside, if things like real wages continue to show positive for any length of time from here, a hike will come sooner rather than later. Now, for the yen, we shouldn't get too carried away too much, as you know, they will take things slowly still, the BOJ. So it's wise not to look for a long-lasting positive reaction outside of a surprise hike move, or an indication that they may follow up with more hikes. For the yen, now I can see some further weakness might be in the pipe with this political story rumbling on, but you may need to get a clearer picture from yen crosses rather than something like dollar yen, particularly due to the Fed noise on the other side. Now, yen pairs closed the gap in EU trade on Monday, and dollar yen remains well entrenched in this rough 146.80s, 148.80s range. So until we get something that moves us meaningfully out of that range, I think we can trade both sides of this. Maybe you look to trade the rallies in Asia session, and then it changes over to what's going on with the Fed and the US in the US session. But ranging for now, and this is something to watch over those elections.
Yeah, sorry, I'm just still in shock that you feel sorry for a central bank. Are you okay? Should we send some medical assistance down to you, mate? Is everything all right?
No, I like the BOJ. They're a good bunch.
Oh, right. Okay, fair enough. Well, each to their own, I suppose.
It's certainly not Bailey, so one extreme to another.
But you are right. I mean, I do feel a bit of it has been sort of self-inflicted, but there's always an excuse for them not to tighten. You know, early in the year, it was trade tensions, then it was political uncertainty around the upper house elections. Then you had a brief window where all was looking rosy, and now the prime minister's resigned, and we seem to be back to square one. All of this, to me, speaks to downside for the yen and downside for JGB, certainly at the long end, the ultra long end. The yen, I think we're looking at a much more dovish path from the BOJ now. I mean, they're going to be on hold until there is clarity on the political front. We won't know the LDP leader for another month. Does that leader then seek a mandate of their own and hold an election anyway? There's a lot of uncertainties to resolve on that front. And then on the JGB side of the equation, I think one of the things that Ishiba was known for was not being a shrewd political operator, because he managed to lose 2 elections in the space of a year, but being relatively fiscally responsible and demonstrating a degree of fiscal restraint. So you'd imagine that all of the candidates to replace him are going to advocate a much looser fiscal stance, which is obviously going to put pressure on that long end of the curve. And correct me if I'm wrong, but I believe 30-year JGB yields are trading at or close to record highs as it is. So it's not a huge stretch to imagine further selling pressure there. And I think I was talking to some clients and journalists about this over the weekend. the way I would look at JGB is a bit similar to how I'd look at gilts. I'm going to chat about gilts in a second. There's always going to be demand for Japanese debt among market participants. If you forget the Ministry of Finance and the BOJ aspect, it's just a question of what yield premium they demand to actually hold it. And I think that's the test, and that's the answer we're going to get over the next 6 weeks or so.
Yeah, and that's one of the big picture things we need to look at in those terms. As rates go higher, then we'll see some of the Japanese whales probably getting more into domestic assets like bonds and things because the yield's now there, and then there's no currency risk as well. But yeah, I think for now that two of the main runners for the leadership contest were the two who went up against Toshiba when he took over. I think it was last July, was it? I think that happened August.
Yeah.
So they're in the frame, and that's something to watch out for in the yen over the weeks ahead. Just who is going to throw their hat in the ring, and whether they're fiscally dovish, hawkish, or whatever. So yeah, there's going to be some volatility creeping up, I think.
Yes. Well, let's hope so. Anyway, right. Let's move on to our plays of the day. Right, I mentioned it a second ago. I'm going to look at gilts this week, the 30-year specifically. We touched 27-year highs on the 30-year yield last week before we did have a modest pullback after the soft US jobs data on Friday. In fact, the only person hoping the US labour market rolls over might well be Rachel Reeves, because it's doing her a bit of a favour in terms of UK borrowing costs. But that does not change the fact that we are on an unsustainable fiscal trajectory here in the UK, nor does it change the fact that these counterproductive, growth-destroying tax hikes that keep getting rumoured are going to be able to fix it, because they're not. We still have 11 weeks to go until the budget on the 26th of November, and there is, of course, the chance that Rachel Reeves pulls a rabbit out of the hat, but I certainly wouldn't be betting my house on it. As a result, I think we're still in a situation where, unless and until spending is cut significantly, we are going to stay in this fiscal doom loop here in the UK, with ever higher borrowing costs, ever higher taxes, and ever slower economic growth. And as a result of that, I think the long end is only going one way for the time being. And it does almost feel as if everyone's kind of gunning for that 6% mark. Are we going to get there by Halloween? Are we going to get there by the budget? Are we going to get there by Christmas? Who knows? But if MPs aren't going to demonstrate any sort of fiscal restraint on their own, then the bond market is going to force them to. So I would be staying short the long end of the gilt curve this week, and, well, probably for many weeks beyond that as well. Ryan, we are going back to Japan.
Yep, going on to Japan again, because since we said so much about what's going on in Japan and the US today, it makes sense to look at dollar yen for my play of the day, as it's going to be in focus a lot this week and for the next few weeks. Now, the Fed trade is always going to outweigh Japanese politics outside of something shocking happening. So I think that the dollar generally is a rally sell from here to the FOMC and maybe beyond that as well. Now, as this pair has the prospect of rallying on Japanese news, I'm going to be looking to hit rallies brought on by any sort of negative moves over Japanese politics. Even if the news is good for the yen, it just adds to the downside pressure for this pair, making it even better as a rally sell contender. Sometimes my trading bias is purely down to weighing up the reasons why an asset might rally versus it selling off. And right now I have a sort of 2-to-1 ratio for selling over buying. So that's the way I'm leaning. So if we get any rallies up towards the top end of that range, as I say, 148.80s, even up to 150 level, I'm probably going to look to hit those.
Good stuff. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Live and Forex Analytics for joining us. Thank you, as always, as well, to our producer, Kyriakos, for bringing things together as brilliantly as usual. If you have enjoyed the show, please do drop a like on the video. Leave a comment as well. Let us know how you're trading the markets, or if there's anything you'd like us to discuss in next week's episode of The Trade-Off. And that is when we will be back, because it's another busy week next week. The Fed, the BOE, the BOJ in the mix, and God only knows what other political shenanigans as well. In the meantime, though, have a very good week ahead. Thanks as always for watching, and goodbye for now.